Hello and welcome to today's daily analysis for the 15th February 2024. The US dollar index for today dropped to about 104.765 on Wednesday because people were selling it after it went up high following the January CPI results that showed the price staying high. The Federal Reserve adjusted its interest rate plans because of this. Even though the dollar went up on Tuesday due to higher CPI, the investors hesitated to believe the Fed would ease up on interest rates because inflation is still a concern. The CPI report mentioned that while goods prices are going down, services are getting more expensive. Looking at the daily chart for the US dollar index, it seems like a good time for buyers. The positive indicators like the RSI slope and the MACD that we see here, rising the green bars, shows the buyers are in control. The dollar is trading above important moving averages, which is a good sign for those who think that it will go up. If there's more good news or support, it might go higher, which there are also levels that might be slowed down or bounce back. The resistance is at 105 and 105.76, while support is at 104.25 and 103.64. And the next for the crude oil, the oil prices started high at around $78.50, but dropped below 77 because the US suddenly got a lot more oil, 8.52 million barrels, the most since November. Even though tensions in some parts of the world are pushing oil prices up, there's too much oil in the US, and the cost is also affected by inflation being higher than expected. For now, oil seems to be doing well, trading around 77.33, higher than the 200 days moving average. Last week, it went past a kind of middle ground price of $75.13 and has stayed above the average for the past 20 days moving average. If it keeps going up, it might hit $78.08, then 79.13, even 80. If things go south, it could drop back to 75.13 or even lower to 74.07 and 73.36. And then for our gold prices, it stayed below 2000 because of a 4.3% US Treasury yield. Even though the gold initially went up, the strong US inflation data and the rising Treasury yields pushed it below 2000 in Asian trading. The people are waiting for the US retail sales and PPI data to get a clearer picture. And with the tensions in the Middle East and Eastern Europe, including the attacks with the Yemen Houthis, the gold might be seen as a safe haven amidst all the uncertainty. Looking at the technical side of things, the gold price might keep going down. Because on the daily chart, the sellers appeared near the bearish 89-day moving average, and the price found some support around the bullish 100-day moving average at 1,990. The RSI is showing a strong bearish trend, indicating a lot of selling interest. If it drops below 190.90 and 1990.50, the next levels are watched at 1978.60 and 1975. On the flip side, if there's a bounce, the gold might go past 2000, aiming for the lower support line at 2016.5 and 2015.5. The AUD gained momentum against USD, reaching around 0.65 after dropping to 0.6442 due to strong US inflation data. Despite the initial rise in the USD, a slight recovery in US stock futures and a decrease in Treasury yields helped AUD rebound. The investors believe the Federal Reserve won't cut rates before June, boosting confidence in the USD. The AUD pair movement is likely influenced by a speech from RBA Governor Michelle Bullock and the Australian employment data. Looking at the technical side, the Australian dollar against the US dollar recently dropped below the 200-day moving average, signaling a preference for bearish traders. The daily chart indicators are in the negative zone, suggesting a short-term negative outlook for AUD. This means that if the price goes up again, it might be seen as a chance to sell, potentially testing levels like 0.64 and 0.6411. If it goes below that ladder, it could move towards the main support at 0.635. On the other hand, a decisive low break above 0.65 could trigger aggressive short covering and push the pair to reclaim the 200-day moving average at 0.6566 and even reach 0.66. The British pound declined to around 1.2535, its lowest in over a week, following disappointing UK inflation data. The Bank of England Governor Bailey noted a data doesn't significantly change their February policy outlook. Weak UK inflation, with annual CPI at 4% and core CPI at 5.1%, along with slower Q4 2023 wage growth, suggested the Bank of England may hold off on interest rate cuts. The traders now focus on Thursday UK Q4 GDP and US January retail sales for potential GP pound trading opportunities. The pound is facing a decline on the daily chart due to disappointing January inflation data, dropping to around 1.2535 from the failed attempt to stay above 1.26. Currently within a downward channel above 1.253, the short-term outlook is bearish after breaking key moving averages. The pair is expected to move lower towards the 100-day moving average at 1.2487, potentially reaching 1.2448. The bulls may struggle to break above 1.26 and 1.2658, with a target around Tuesday high of 1.2685. For the Japan yen is on the rise due to a positive outlook for the US dollar, reaching a 3-month high at 150.88 after the Bureau of Labor Statistics reported US inflation above 3%. Currently trading at 150.78, the pair is consolidating ahead of Japan's GDP and US retail sales data. The US Federal Reserve is expected to maintain interest rates between 5.25 and 5.50% for the first half of the year, supporting the dollar. The Bank of Japan suggested that even if the negative interest rates end, loose financial conditions will persist, potentially limiting the yen's strength. On the daily chart, the Japan yen broke above the crucial 150 resistance level, indicating potential for further gains towards 151.38 and 151.91. However, a drop below 150 could lead to a test of 148.37, with additional support at 147.45 and 147.49, marked by the 10-day moving average and 61.8% Fibonacci bounce level. The pair is currently in a consolidation phase after a series of doji stars, and its future direction may be influenced by upcoming economic data and central bank statements. And then for the euro, it is attempting to rebound from 1.07, but it faces challenges due to a strong dollar support following the robust US inflation data. The pair held around 1.0695 after hitting 3-month lows. The dollar gained support as investors believe in the Federal Reserve won't cut rates in March. However, the euro found relief from positive economic confidence data in the Eurozone and Germany. Market attention now turns into the speech by ECB President Christine. There's speculation that the ECB might consider rate cuts in the second quarter, but comments from ECB suggest they may not be dramatic measures to combat inflation. If the Euro USD breaks below 1.07, it could target 1.0516 and 1.0495. Further downside may lead to 1.0448 and 1.04. On the upside, breaking through 1.0775 is crucial for reaching 1.08, with potential for further rise to 1.0869. And this is the end for today's analysis. Thank you.